In today's video, I'm going to demonstrate to you a trading strategy that has a win rate or accuracy of 87%. It's a mean reversion strategy, and we're going to use Williams percent R indicator to look for trades on the daily chart for the FTSE 100. I'm using the FTSE 100 or the UK 100. It's a CFD provided by Oanda. Now, we're looking at daily charts, but their daily chart is made up of a session starting at 8 o'clock in the morning, that's GMT, through to 16:30 in the afternoon. So if you want to follow along, replicate what I'm going to show you in this video, then make sure you're using those times too. I'm going to show you how to identify the trade setup, how to get in and out of the trades, and then we're going to try and go for some improvements. But this time we're not looking to improve net profit or the average trade. What I want to do is actually reduce the drawdown of this trading strategy, and I'm going to show you two different techniques that hopefully one or both of them might work. This strategy is going to be a long only strategy, so we're only looking for buy trades, and that's because we're trading a stock index which over time traditionally just goes up. So we're going to use that to our advantage to improve our edge. The idea is mean reversion, as I said, so what we're looking for is to identify and buy some dips in a longer term uptrend and then not actually get out until we see some profit in that trade. And because that's our method, we do see some quite large drawdowns, and hopefully once I've applied one or two different methods that we're going to show you, then hopefully that will reduce those drawdowns and make it a much more tradable strategy. I'm going to do what I normally do, so I'm going to be using some in-sample and some out-of-sample data. The in-sample data that I'm going to look at is going to be from 2008 through till the end of 2018, and then we'll have a look at making some improvements, making some adjustments, and then I'm going to look at what happened to the strategy going from 2019 through till present day. I've got data up till February 2021, and hopefully any of those modifications that we've made haven't disrupted or over-optimized and stopped the strategy from working for those extra out-of-sample years. In this test, I'm going to be trading a fixed 10 contracts. Now, 10 contracts of this CFD is equivalent to £10 per point of the FTSE 100 index. So let's go over to the charts and I'll show you how to get in and out of the trades, and then we go through each development of the process. First off then, let's have a look at the daily chart of the UK 100, and I'll show you how to get in and out of the trades. So here's the chart, and we've got Williams percent R indicator put on the bottom of the chart here. I expect some of you have seen it before. It just looks like any other oscillator really. Now what we're looking for is the indicator to turn from above 20 to below 20. Now multi-charts, if you look on this scale here, multi-charts draws Williams percent R from 0 to 100, but if you're using TradingView or another platform, it might draw it slightly different, but ultimately we're looking at the lower 20% of the indicator, so in my case it's 20. Now we go to the first trade, which is here, this one. What we can see is in this little square box we can see that it says percent R equals 28.48, so that's what it was. The next bar we can see that percent R equals 1.96, so it's gone from above 20 to below 20. Now that's our simple signal to go long, so on the next open we buy, and you can see on the next bar we've made a buy. And the exit's even simpler. All we're doing is we're looking at each time the bar, or very near the bar, when the bar closes, if we're in profit, the minute we're in profit we exit. So this bar here was the next one that was in profit, and then we literally get out of the trade on the next open, and you can see that's what happened here. We carry on. We've got Williams percent R is showing 43.82, then it moves to 13.42, so that's our signal to buy at the open, and you see our buy trade. The next bar closed, was in profit just, so we exited at a profit. Then we didn't see any values of the Williams percent R less than 20 until this bar here, and you can see we've entered the next one. So I think you get the idea, ever so basic. Williams percent R reading in the lower 20%. We enter long and we wait until we've got a profitable close and exit at the next open. 20 and 80 are quite standard levels for use of Williams percent R, and currently I'm using a 14 period, which is the standard length for the indicator too. So with that said, let's have a look at the results to see how this strategy performed using those standard settings. Now, there's the equity curve, which is pretty nice. This equity curve here kind of gives us quite a good idea because it also includes drawdown. If we look at this equity curve, which is the close to close, it marks every closed out trade, and you can see it's a beautiful equity curve. However, it doesn't show us the drawdowns, which this one kind of does. You can see these drawdown periods, and we can see that a bit better by looking at this one. We can see these big drawdown periods that we would have had to go through before we closed out for a winning trade. Okay, so it's a decent equity curve. We've made 51,000, almost 52,000. We can see that our max drawdown here is almost 10,500. If we look at the total trade analysis, it's 114 trades. We've got an accuracy or percent profitable of just over 87% profitable, and quite a large average trade at $455. This strategy isn't including costs, but even with costs, 455 is quite a big average trade. It's a very acceptable average trade. So let's move on to the next workspace where we're looking at our first filter to try and improve or lessen those drawdown periods. In this workspace, we're using this moving average line. It's a 200 period simple moving average, and it's a bit of a classic kind of uptrend or downtrend filter, bullish, bearish type filter, especially on the daily chart. So what we're doing here is literally we're only going to go long if the closing price is above that 200 period moving average. And if we zoom out, we can see that when the price comes below that average, we're not taking any trades. And the minute it's back above, then we start to take the trades. So let's see how that's affected our performance report. We're even more accurate now. We've got an 88%, taking less trades, 88%. The average trade ever so similar. Let's look at the net profit. We've got less net profit. We've got about 10,000 less net profit, but the drawdown has reduced, which is great. Now we're only at 7,895, which is an improvement over not using the 200 period moving average as the filter. But perhaps there's a better length for that 200 period average. Maybe there's a better filter. So in the next workspace, what I've done is I've actually optimized the length of that moving average. You can see here in this right hand column, I've got the filter moving average length, and I've started from 10 and I've gone all the way to 200. I don't want to go more than 200 just because 200 is sort of the recognized filter. And straight away we can see that 200 actually made the most net profit, although the average trade would have been higher around here using about 100 or a 90 period moving average. But for this test, what we're most concerned about is the intraday drawdown. And you can see that apart from anything less than 60, the drawdown stays the same for all of these. Now, we could go less than 60 and reduce that drawdown, but look at how many trades that it filters out to, and obviously we're making less than half of the net profit. So for just a very, very small decrease in the drawdown, we're losing a load of profit. So as far as I'm concerned, there is no better option here apart from using the 200, which we already were. So we're going to stay with 200 for the minute. In the next workspace, I want to look at the level of the Williams percent R. At the moment, we're taking trades when it gets below 20, but perhaps there's a better level there too. In this optimization, I've looked at levels from 30. I don't really want to go too much higher than that. So I've gone 30 down to 25, 20, all the way down to 5. And that's our 20 is what we were at. And again, look at the max intraday drawdown. They're the same, aren't they? So I don't want to mess about with that. It's not really worth it. You could argue that we could go to 30 because it does make a bit more net profit, makes more trades, and the average trade doesn't really decrease too much. The percent profitable decreases ever so slightly, so you could argue that using 30 was the best. However, I'm going to leave it at 20 because the less we mess about with these numbers, the less likely that the strategy will stop performing in the future on that out of sample or future data. Next, I decided to use a method of actually reversing the trade if it goes too far against us. So at the moment, if we're in a long trade and it starts to dip more and more and build up a bigger and bigger drawdown, then is there a point where we can say, actually, let's reverse this trade, let's get out of the long trade and let's go short and make some money on the short side, because the market is obviously still correcting and it isn't ready yet to rebound and continue on up. So that's what we're going to look at. But before then, if you're finding this video helpful and you like it, you find it useful, please give it a thumbs up because that helps me. So what I've done is I've programmed into the strategy to say that if the trade is going against us by a certain amount of pips, then get out of the long trade and go in short. And we can see there's an example here where we were in the trade, it went against us, and we actually went short, and we did actually make a bit of money off that short. Now, we can't just guess at what level that's going to be. You know, it could be 10 points, it could be 100 points. We can't just guess that. So let's run an optimization, see if there's an optimal number for that. So in this right-hand column, we can see that we've got this input called reverse trigger. And for each minus 100, that's 10 points, minus 200, 20 points, and so on. We went all the way to minus 500 points against us. And looking at the max intraday drawdown, I noticed that anything from around minus 400 points to minus 4,500 points kind of worked best to give us the least intraday drawdown while still giving us a reasonable amount of net profit. The net profit has reduced a lot and the size of the average trade has reduced a lot, but we have reduced that intraday drawdown as well. So let's try 440 points. Now our net profit has decreased. It's gone down to 27,800 rather than 41,000. But our strategy drawdown has decreased. So let's have a look at the equity curve. Equity curve is reasonable. You can see these drawdown periods. The close-to-close equity curve looks different now because we're exiting with some losing trades, not just winning trades. But overall, it's still a decent equity curve, but we are sacrificing a lot of net profit for just a little improvement in the overall drawdown. Now, what I've done in this workspace is I've removed the 200 period filter and just kept that reverse trigger amount in. So we better do a re-optimization as well of that amount. And here's the reverse trigger column again, and I'll just quickly scan down and I'll show you what I've chosen. I actually chose 4,500. It's amongst these lower drawdowns and it's still retaining a decent amount of trades and some net profit. The average trade has gone down again, but let's have a look at the results using 450 points. We've got 30,000 now. Our max strategy drawdown is larger than using both the reverse trigger and the 200 period moving average as the filter. Equity curve is very similar, and our accuracy has gone down now because, like the previous workspace, we are now taking losing trades. Personally, for me, evaluating both using the reverse trigger and the 200 period moving average or using them combined, I actually like just the simple one, just using the 200 period moving average on its own. Now the next thing to do is look at the stop loss, because we haven't got a stop loss at all. So let's have a look at using just a fixed pip stop loss, and we run an optimization. You can see on the right here, my stop is 0 is no stop loss. We've got this net profit of 41,000. We're still using that 200 period moving average as the filter. We're not using the reverse trigger here. Average trades are decent, 451. Now you can see straight away that stop losses really reduce the profit here, and I ended up going through all these and picking 450 pips. The drawdown was one of the lowest, the net profit was one of the highest to using a stop loss, and the average trade was one of the highest too. You can see as soon as we get past 775 points, then the results become the same as using no stop loss, because it's so wide that it never gets hit anyway. But we need a stop loss, so let's use 450 and see how that looks in the results. And you can see our largest losing trade here. It's actually 496 points, so we had a bit of slippage there. Net profit is less, it's only 26,000, it was 41. The strategy drawdown is less though, is at its lowest at 5,166, but at the sacrifice of a lot of net profit. The equity curve still looks okay. The close to close equity curve still looks similar. So that 450 pip stop loss works okay, but does reduce a lot of profit. Now the last workspace I want to look at is using that out of sample data. If I show you, this is the previous workspace that we've been looking at. We got data from 2008 through to the end of 2018. And then in this last workspace, we've got data from 2008 through to, well, we're in 2021. If I show you on the chart here, 17th of February 2021. So let's see. What I've done is I've removed the stop loss. We've got that 200 moving average filter, and we can see, look, we're making new highs at the very last trade. So that's great. So that's showing that the behaviour of the FTSE is still the same as it was throughout the rest of the test. We've made a few more thousand because we've had a couple more years, not that much more, but we have made a bit more. The strategy drawdown hasn't really gone up. We can probably see that looking at this chart here. We haven't had any big drawdown periods in that out of sample data now. It's just a shame that using a stop loss on this type of strategy hinders the performance in like the net profit so much. But we need a stop loss because it is risky trading without a stop loss. Maybe you've got some ideas of how to improve this strategy. If you have, then comment below and I'll look at doing the modifications and maybe making a future video with those too. So that's about coming to the close. We've seen an effective way of using Williams percent R to identify decent pullback areas in the FTSE 100. I use Williams percent R, but really you could use any oscillator. Something like RSI would do the same job too. In fact, there are ways of identifying pullbacks like that without using any indicators at all. I've done videos on that, which I'll link because you'll probably find those quite interesting. And once we've got in the trades, we've had a look at a couple of different ways to reduce the overall drawdown. And we've concluded, or I've concluded, that I think the best way is to use that classic 200 period moving average filter to filter whether we take the long trades or not. Well, thanks for watching this far, and I realise these videos, they do tend to drag on a little bit when I walk you through each step of the process that I'm going through. I try to keep them as brief as possible, but I also want to give you all the information. But if you think they're too long, let me know, or if you think they're okay, let me know too, so I can make the best possible videos for you guys. And until the next one, this is Jared Goodwin, and thank you.